is that I don't own gold because I think it might go from 2,100 to 2,500. I buy gold because I'm afraid it's going to go to 7,000 or 8,000. The set of circumstances that would give you a quantum increase in the price of gold are almost invariably unpleasant. I would prefer that it didn't happen. I'm a 71-year-old guy, very happy with his current lifestyle. I'd like to see no disruption. But I see a whole bunch of reasons why gold could go to 7,000 or 8,000. I'm not saying it will. What I believe is that it is a contingency that is certainly worth insuring against if you can do it, and I can do it.
Rick Rule, a renowned investor and the founder of Sprout Global Resource Investments, foresees a significant increase in demand for precious metals in 2024. He attributes this expectation to the worsening macroeconomic conditions both in the United States and globally. Rule predicts a fourfold surge in demand, which he believes will promptly impact prices. Consequently, he anticipates gold reaching unprecedented levels, potentially between $7,000 and $8,000 per ounce by year-end. While Rule acknowledges that his forecast is not definitive, he highlights the high likelihood of such an outcome given the widespread mismanagement of economies. Despite the current record-high gold prices, Rule remains cautious, pointing out persistently low prices due to declining demand. However, he underlines the potential for increased interest if the economy enters a recession, or if the banking sector faces another crisis, as historical patterns suggest investors tend to turn to precious metals during economic turmoil. In a recent interview, Rule discussed the motives behind central banks' gold acquisitions and his confidence in further price escalations.
In a rear-looking way, the answer to that's no. The buyers have been the central banks. And the central banks' motivations have been primarily the weaponization of the US dollar, the attempted export of U.S. policy and political norm to other countries outside the U.S. dollar. The United States government, has tried to use the U.S. dollar to increase its influence in a bunch of countries that don't particularly want to be influenced by the United States. The consequence of that is that the countries have, of necessity, begun to substitute U.S. treasuries and U.S. dollars as both stores of wealth and mediums of exchange. We have seen consistent outflows from retail physical ETFs, which suggests that in Western nations, at least, the citizenry have not been active buyers of gold. In fact, they've been active sellers of gold. The gold price has moved up because the central banks don't trust the United States, and after not trusting the United States, they don't trust each other, so that the mediums of exchange outside the US dollar aren't really renminbi or yen or rubles, dinars, or anything like that. Increasingly, you will see them short-term in gold or in dollars. My belief, however, is that the ongoing deterioration of the purchasing power of a bunch of fiat currencies, but the most important of which is the US dollar, the reserve currency, will cause more and more human beings opposed to governments to also view gold as a store of value. Anthony, it's worth noting that in the largest savings and investment market in the world, the United States, which accounts for, at last count, 23% of savings and investments worldwide, that the market share of precious metals related investments relative to other forms of savings and investment assets is less than 0.5%, which is to say that 0.5% of all savings and investment assets are involved in precious metals or precious metals related assets. The mean market share of precious metals over the last 4 decades, according to JP Morgan Chase, was 2%. So if we merely had reversion to mean, which is what I think we're going to have, you would see demand for precious metals and precious metals related assets in the United States, the foremost savings and investment market in the world, quadruple. And I think that's precisely what's going to occur. People have been saying to me, Rick, when is the gold price going to go up? I began adding to my personal bullion holdings in 1998. So I view the ascent of the gold price really as having started in 2000, which is to say in 2000, the price of gold was about $250 an ounce. Now it's about $2,100 an ounce. So I would suggest that gold has done what, 8.6, 8.7% compounded a year for 24 years? When is gold going to go up? Well, the year 2000. People have expectations that were set in the decade of the 1970s when the gold price went from $35 an ounce to $850 an ounce. Rational expectations would suggest that the answer to that question is in hindsight. My personal belief is that the rate of increase in the gold price is going to accelerate because of the deterioration in the purchasing power of the US dollar, particularly relevant to the interest paid on fiat-denominated savings products.
Rick Rule explains that central banks, rather than individual investors, are primarily driving the current surge in gold prices. He attributes this to central banks' motives of leveraging the US dollar for geopolitical influence leading to a loss of trust in traditional fiat currencies. Rule predicts that as fiat currencies, particularly the US dollar, continue to lose purchasing power, more individuals will turn to gold as a store of value. He notes the low market share of precious metals in the US investment landscape and anticipates a quadrupling of demand for precious metals and related assets. Rule's analysis suggests that the ongoing depreciation of fiat currencies will further propel the ascent of gold prices, expecting the rate of increase to accelerate in the coming years.
In terms of the broader commodities, Anthony, I think the real story is the ascent of humankind, if you will. There are over 8 billion of us on Earth, more every day. We've done a great job over the last 40 years, increasing the material well-being of the poorest of the poor, raising 1.5 billion people from dire poverty being merely poor. That isn't to suggest that there's a lot more to do. There is, and we're going to do it. As poor people get more money, the things that provide utility for them are things that are commodity intensive. When wealthy people or middle income people get more money, they generally buy services which are not commodity intensive. But when poor people get more money, the stuff that increases their sense of well-being is often stuff that requires stuff. The great commodities boom that we saw as an example in the decade 2000 to 2010 really came about as a consequence of the urbanization of China, and that process is being repeated around the world. As a consequence of that, I am bullish about the whole industrial materials segment, with the sole caveat, no, that's not right, with two caveats. One caveat would be the increasing role of government and the increasing amount of government theft with regards to privately generated wealth, including in natural resources. And the other would be the threat of recession. I'm no economist, but I note once every decade and a half something goes way wrong. And it's been a while since something went wrong, so I'm a little nervous about the specter of recession, which would delay rather than change my forecasts of increased commodity consumption, reduced availability. All commodities will benefit, but I think that investors will benefit from the biggest markets the most, which is to say they require the least effort, and they have the biggest and the best companies in them. So I would start with the oil and gas business. There's a perception around the world that fostered by the big thinkers, if you will, that peak oil demand occurs in 2030 or 2032. This is pure hokum. Peak oil demand probably occurs in 2065. If you think about peak oil demand occurring any quicker, how would the big thinkers manage to fuel all the private jets that they fly to Davos to tell you to drive less? The truth is that we have invested as a group well over $5 trillion now to increase the market shares of alternative energies in replace of hydrocarbons, and we've reduced the market share of hydrocarbons from a high of 82% all the way down to 81%. So I would start with oil and gas, not that I think it's going to do better than other commodities, but simply because it's such a great business. Current oil prices, oil and gas companies are making a lot of money. Despite the fact that they're making a lot of money, in particular, the state-sponsored sector isn't spending enough money on sustaining capital investments to maintain production, which sort of suggests that prices will stay higher for longer. As I say, not maybe the commodity that will enjoy the greatest price increase, but the one that offers the greatest stability and the greatest free cash flow and the least risk for investors. I'm certainly a copper bull as well, but I'm not alone in that thesis. We have underinvested for 30 years in the exploration for and development of copper mines. The consequence of that, with the electrification of the world, is that we face almost certain shortfalls, supply over demand. The timing of that really is a function of whether or not we enter a recession or not. You can reduce supplies if you reduce demand via a recession, and you still don't get a price increase. Absent a recession, I think the copper business looks extraordinarily good.
When examining the broader commodities market, Rick Rule perceives a profound narrative of human progress intricately tied to the material well-being of billions worldwide. Over the past 4 decades, he observes a notable improvement in the living standards of the impoverished, a transformation largely fueled by expanded access to commodities. Rule emphasizes how these essential resources have played a pivotal role in enhancing the quality of life for disadvantaged populations, juxtaposing this against the consumption patterns of wealthier demographics, who tend to favor services. Reflecting on the commodities boom of the 2010s, primarily propelled by China's rapid urbanization, Rule anticipates a similar trajectory unfolding on a global scale. However, amidst his optimism, he issues cautionary notes regarding two key factors: government interference and the looming specter of recession. These potential stumbling blocks, if not managed effectively, could pose significant challenges to the trajectory of commodity markets. Despite these concerns, Rule maintains a positive outlook regarding commodity consumption and supply dynamics. He asserts that the largest markets often present the most promising investment opportunities, citing the resilience, steady cash flows, and comparatively lower risks associated with the oil and gas sector. Additionally, Rule expresses bullish sentiments toward copper, citing both underinvestment in exploration and the growing demand fueled by the rise of electrification. In summary, Rule envisions a bright future for commodities, contingent upon the prevailing global economic conditions. He underscores the pivotal role these resources play in shaping the trajectory of human progress and encourages thoughtful consideration of the opportunities and challenges ahead. Thank you for your ongoing support. We invite you to share your insights on Rick Rule's perspectives and engage in discussions about the future outlook for gold and silver in the comments section below. Don't forget to like, subscribe, and enable notifications to stay updated on future content.